Hi everyone, I am Dr. K. Amudal, Assistant Professor in Commerce, PPG College of Arts and Science, Coimbatore. Today we are going to learn an important concept in income tax called scope of income. Before calculating income tax, we must first understand what is considered income and which incomes are taxable or exempt. Every individual earns money from different sources such as salary, business, rent, interest, dividends, or investments. The Income Tax Act determines whether these incomes are taxable. By this end of this session, you will be able to understand the meaning of scope of income, identify different types and sources of income, differentiate between taxable and non-taxable income, apply the concept using practical examples. Students, have you ever wondered why some people pay more tax than others? The answer depends upon their income and the type of income they earn. Understanding the scope of income helps us manage our personal finances wisely, calculate income tax correctly, avoid legal problems caused by incorrect tax filing, plan investments and savings effectively. For example, suppose two friends earn 8 lakhs annually. One earns only salary, the other earns salary plus rental income and bank interest. Although their salary is the same, their total taxable income may differ because of additional sources of income. Therefore, understanding the scope of income is essential. What is scope of income? Now, let us understand the meaning. The scope of income refers to all kinds of income received by an individual or entity that may be considered for taxation under the Income Tax Act. Income can be received either in cash, in kind, or goods in the form of services or benefits. Income may arise from employment, business, property, investments, other legal sources. Therefore, the scope of income means the complete range of income that the Income Tax Act recognizes while calculating tax liability. Remember, income is not limited to salary alone. Business profits, rental income, dividends, interest, capital gains, and many other receipts also come within the scope of income. The types of income is divided into three types. Earned income is the income received by activity working. For example, salary, wages, commission, bonus, professional fees. Example, a teacher receives 50,000 salary every month. This is earned income. Next one, passive income. Passive income is earned without actively working every day. For example, rental income, royalties, income from investments where active participation is not required. Example, if you own a house and receive rupees 20,000 monthly rent, this is passive income. Third one, portfolio income. Portfolio income comes from investments. Examples include interest from bank deposits, dividends from shares, capital gains from selling investments. Example, if you have invest in shares and receive dividends, that is portfolio income. Next one, sources of income. Income may come from different sources, employment and business, then investments and property and other sources. The employment and business example, salary, business profit, freelancing, consultancy, self-employment. Second one, investments and property. For example, interest, dividends, capital gains, rental income. Then other sources, example, pension, government benefits, certain gifts, family pension. A person may earn income from multiple sources simultaneously. For example, a professor may receive salary from college, rent from a house, interest from fixed deposits, dividends from shares. All these incomes together form the person's total income under the Income Tax Act. Taxable versus non-taxable income. Now comes the most important concept, taxable income. Taxable income is income on which tax must be paid. Example, salary, business income, interest, dividends, capital gains. Non-taxable income. Some incomes are exempt from tax. Examples, certain gifts within prescribed limit, eligible scholarships, life insurance proceeds, certain employee benefits. Students, you should know that not every receipt is taxable. The Income Tax Act provides exemptions for specific incomes. Therefore, while calculating tax, we first identify taxable income, exempted income, and then calculate tax accordingly. Over 70% of personal income is subject to income tax in most countries. This means the majority of what individuals earn from wages, salaries, business profits, and investments falls within the taxable scope. Understanding which portions of income are taxable is essential for accurate reporting and effective financial planning. Common income exclusions. Some incomes are generally excluded from taxation. These include gift from inheritance, real life example. Let us understand through Jani's example. Jani earns salary $60,000, rental income $12,000, gift from aunt $10,000. Analysis: salary, earned income, taxable. Rental income, passive income, taxable after allowable deductions. Gift falls within the exemption threshold, non-taxable. Therefore, Jani's total receipt include three different categories, but not all are taxable. This example clearly explains how the scope of income helps determine tax liability. Today, we learned meaning of scope of income, types of income, sources of income, taxable income, non-taxable income, practical application through an example. Thank you, students. Thanks for watching.